Ahoy there, trader, and welcome back. This is the Anti-Investor Swing Trading Podcast. Let's talk about the most common trading mistakes. Now, there's a huge difference between the average trader and even just a moderately okay trader, and it's not what they do that makes a difference, but more about what they don't do. Welcome to the Anti-Investor Swing Trading Podcast, where we talk about swing trading stocks, stock options, and index futures. My goal is to help the next 1,000 traders become financially independent and retire early from the financial markets by providing the right tools to use, rules to follow, and the software to assist you, so that you don't make the same mistakes that I did. And from now on, I'll be your personal trading mentor to show you the way. Also, if you like what you hear, please show your support by taking a screenshot and sharing on LinkedIn, and you'll get bonus points for tagging me in. Today, we're going to look at some of the bigger mistakes that traders make and how to overcome them. And while mistakes are a part of any learning process, which helps to develop experiences and perspectives, today we're going to look at 6 of the best. So, the first of my big list is essentially over-leveraging or trading too big of a position size. So many traders start their trading career by focusing on how much they can make, and if they're right on a trade, then they want to get as much out of it as possible. Yet the professional traders think quite literally 180 degrees in the opposite direction. They will always focus on how little they can lose if they're wrong. So as such, the novice trader ends up focusing on putting as big a position size on as possible, because YOLO, and surely this time it's going to the moon, and you know what, let's see how much money we can make, essentially. That's the attitude. Again, you only need to look at Reddit and Wall Street Bets forums and do quite literally a quick search for loss porn, and you will see people bragging about how much money they've lost on these crazy YOLO ideas. 100,000, 200,000, $250,000 here. It's all on one trade idea, because for some crazy reason, buying $100,000 worth of deep out the money puts seemed like a great idea, and it amounts to nothing more than a lottery ticket. Now, the smart money, they will size their risk in proportion to their account, which can be as little as 1%, and anywhere up to 4%, so 1, 2, 3, 4% of their capital at risk on any one trading idea. Because if they protect their risk capital, they're going to be in the game. Because, again, not every trade is going to be a winner. If you've got a 30% success rate, that's pretty good. Again, compare it to baseball. If you've got that 30% strike rate, the hit rate, that's pretty good, which means you're going to miss 70% of the swings that you make. And that's okay, because those 30% are going to, 3x, 4x, 5x, they're going to grow the account, again, on the assumption that you've got a positive expectancy strategy, which is a fancy way of saying it makes money on average. And again, on average, we're looking to be a winner. Now, that means that when you have the small acceptable risk, you're not losing sleep, you're not got sweaty palms, you're not trying to cherry pick the best opportunities, you're basically just taking the setups. It keeps you able to be able to follow your trading plan, again, assuming that you have a proven process. And again, you're not betting the farm, you're keeping losses small, they're manageable, and quite literally, the rewards take care of themselves when you think about things in these terms. The second on my list is trading without a plan or a journal. It boggles my mind when I hear a trader or an investor that doesn't have a simple set of structured rules to follow. Again, it doesn't have to be complex, but if you think about it in a different context for a moment, if you were starting a business, bricks and mortar business on the main streets, you would sit down and you would have a plan. You would work out, your opening hours, how many staff you're going to need, your marketing budgets. You'd maybe get some financing to help. Maybe you're going to think about the products that you're going to sell. Which ones that you're going to favor over others in the same range, etc., etc. And even if you've never started a business, you certainly work for a business, and you've got an appreciation for these things of how even a crappy business is ran that, as long as it's making money and paying the wages, it's got to be doing something right. And they have a plan. They've got a list of things that they do and a list of things that they don't. A regular business is not selling fidget spinners one day, unless they're Walmart, of course. They sell a little bit of everything. But most businesses focus on one activity. You're not selling fidget spinners one day, ladies' shoes on another, designer Rolexes on the next day. You're not jumping around trying to figure it out. They've got a plan and they stick to their lane. And we all know that to be true. But for some reason, as soon as we move into the business of trading, all that common sense gets thrown out the window in favour of the make it up as you go along method. So is it any wonder then that 90% of traders blow up 90% of their trading accounts in the first 90 days of trading? Because they're just quite literally going pew, 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 and treating trading like it's Nintendo, and just this'll do, that'll do, YOLO, buying lottery tickets. It's crazy. We know it's crazy, but do the same common sense approach in trading that you know to be true in business. You're not going to go too far wrong. So basically get a plan, or get a mentor if you don't know how to create your own trading plan. I don't care whether it's me, my strategy, someone else's strategy. Just find a strategy that makes sense for you and your situation. Again, quick example to illustrate this. If you see a successful day trader who's also a mentor, who is posting great results and great success and has got a nice simple strategy that's reasonably easy to follow, maybe you are attracted to it. Just put the brakes on for a second and ask yourself the simple question: do you have the means and the ability to day trade in a similar way? If they're spending 2, 3, 4, 5 hours looking through charts to find day trade opportunities, are you able to emulate that in the same way? Because maybe you've got a day job, maybe you've got other things, maybe you've got family commitments. Practically, you're not able to follow the strategy. So it, of course, won't work for you. So it's not just about finding a strategy, a profitable strategy that makes sense to you. Do you have the ability to follow it? And do you have the, just from a simple time point of view, if you've got an hour in the day to check in, any time during the day, maybe you can apply a short-term swing trading strategy that lasts anywhere from 1 to 3, maybe 4 days. That's one of the strategies that I teach. If you've not got time to do that, then maybe you can only check in at the end of the day, when you've got home after work, you put the kids to bed, you can sit down for 20, 30 minutes, at least 2 or 3 times a week. Then I refer to that style of trading as swing trading. For me, that's a part of my strategy as well. I've got multiple strategies that I like to adopt. And I can do that, check in 2 or 3 times a week, and get paid ideally from swing trading at the end of the month and the end of the quarter from those swings, and only have to check in a couple of times a week. It becomes really straightforward when you think about, okay, well, what do you want from trading? Not profits. We're assuming that that is a byproduct of any successful strategy that is applied. But think about what you want. Fast forward 5 years, for example, and you're doing it successfully. What does doing it look like to you? Is it sitting there all day, every day, flicking through chart after chart after chart after charts? At the sacrifice of what? The day job? Family commitments? I don't want to sit here all day, every day. I did that for 12 years. It doesn't appeal to me in the same way, so I don't want to do it. So whenever I design strategies, and I've got several, I want to be able to check in, check for trades, and check out. For a day trading strategy, I want to be able to check in at 9 a.m. or 10 a.m. Eastern, see if I've got the setup, place the trade, and then walk away until the closing bell. That's how I want to day trade these days. I'm very good at it. Similarly with swing trades, I want to check in 2 or 3 times a week for 20 minutes and go through the portfolio of stocks that I have, check in, check for trades, manage trades, then check out. Maybe I don't need to check in tomorrow because I've already evaluated all my positions and doesn't appear to be any new positions. It's a mechanical checklist that I go through. I refer to what I do as a production line. Step 1, step 2, step 3, step 4, and we're done. Walk away for the day, the week. Maybe you can take a few days off. You don't have to check in. So that's the way that I want to apply trading. That's what I mean by how do you envision your trading day? Can you do it with your current time commitments and time availability? So get a plan, get a mentor is the fastest way to see success relative to you, your situation, and your requirements. Now, the third issue is, again, this is my personal bugbear, staying glued to the screen. It's such a frustrating thing, and I get it. While you're brand new, it's like you want to sit there, you want to look at the charts, everything's exciting. But after a while, and again, I did it for 12 years, the first 12 years of my career, it's like it loses its appeal when you've figured out a successful strategy and what a successful strategy looks like for you, and it's working consistently and regularly, and it's putting, money in the account, and you're seeing it compound and all that jazz. Maybe you don't want to sit in front of the computer all day. Again, flicking through chart after chart and hoping to find a needle in a haystack. For me, I don't think that's the productive. I'd rather adopt a more farming approach. I look at, just for example, on the day trade side of things, I look at 5 stocks today, and I'll know today if there's an opportunity for tomorrow. It's very simple, and there's going to be days where there is no day trade opportunity. Similarly with the future strategy that I have, I can check in at 9 a.m. Is there a setup? No. Okay, I can walk away and come back tomorrow. I've got a very clear go, no-go system. So, and it means that I don't have to hunt for opportunities. I'm just farming. I've got the seeds, the 5 stocks and the 1 futures chart that I like to day trade. And I can check in at the opening bell with minimal time efforts, because I know exactly what I'm looking for. Is it there? Yes or no? If yes, place the trade. If no, come back tomorrow. That's what I want. So it means that I'm not glued to the screen. Now think about other styles of day trading. They typically revolve around what I refer to as hunting. They are hunting for the opportunity, flicking through chart after chart after chart after chart after chart. You're trying to look at everything every day, all of the time, and find a needle in a haystack. Sometimes you'll find several, and other times it's just you were looking left and the opportunity was on the right. And that's just the way it is sometimes, because you're looking at too much. And this ties into that lack of trading plan. If you don't have a plan, then you don't really know what you're looking for. I know very specifically the setup that works for me, that I'm looking for, that produces regular results. So that's all I'm looking for. Look at 5 opportunities, look at 1 opportunity. One of my students looks at just 1 stock chart in the week, because that's convenience around the day job and other commitments and family life. And at the opening bell, they can check 1 chart, it's either there or not, and they'll know the day before if there's an opportunity for tomorrow, and they can put 30 minutes aside around the opening bell. It becomes an easier approach to tackle when you've maybe got 2 or 3 opportunities in the week, and again, you'll know today if there's an opportunity for tomorrow. It's very clear. Even Warren Buffett has a clear blueprint of what he's looking for in companies that he likes. Every hedge fund in the world has a proven model that investors can look at to determine if it meets their trading or investing criteria. This is how your pension funds and retirement accounts are managed. Your advisor often does this on your behalf. You just say, I want this, 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 and this in part of my retirement strategy, depending on how conservative or aggressive you are, and they will go and find the right investments based on that criteria. That's what your financial advisor is going to do. But the point is they have a process, a strategy that means that you don't have to be glued to the screens. So again, when you're looking to self-direct your own trading or investing, know what you're looking for. Then you can simply screen for those criteria. And often it can take many thousands of stocks in the known universe down to maybe 3 or 4 a day, or 3 or 4 a week, or 3 or 4 a month, depending on your trading and investing requirements. And then it is quite literally simple and easy to implement, that is efficient without wasting time. Number 4, getting impatient. This is a human nature thing, really, and learning patience is going to be a significant step forward for you. I used to do all sorts of crazy things to try and curb my enthusiasm to click confirm and send on the order. Back in the days before wireless wireless mouse, I would unplug the mouse, so I'd have to physically go, under the back of the computer, unplug it. So it just put a speed bump in my way to prevent me from being trigger happy. And the act of trading, it is perceivably, pew, 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 trade, click, click, click. And the reality is it's waiting. Waiting is how we get paid. And most traders want some form of immediate gratification. And what we need to do is simply reframe how we view the act of trading. Because contrary to popular belief, there are more than 2 types of trades that can be placed. There's obviously long, there's short, but the most important one is sitting in cash and waiting. And even when you're in a trade, you've got to wait for it to do what you anticipate or expect it to do as per the strategy and the research that you've done. So waiting is probably 95% of what we do. And the actual act, the physical activity of trading, again, assuming that you've got a strategy that you're confident with and you know the process for, 90-95% of the time is waiting for the right setups for the strategy that you follow. That's critical. So patience is one of the harder skills to master, and you can probably start to see why. I refer to what I'm doing as farming. Ironically, I grew up on a farm, so I'm very used to the concept of you literally plant seeds and you wait for the harvest to yield a crop. It's just such an apt metaphor for what we do. I have, for example, on the swing trade side of my strategies, I have a group of 25 stocks, my seeds, and I just wait for them to yield an opportunity so I can place my trade that would yield a result. And some of those are not going to work out. And some of them are going to be okay, mediocre, and then some of them are really going to quite literally 10x and you'll go to the moon. Now, I don't know that it's going to do that, but if I just focus on 25 stocks that are ideal candidates for my style of swing trading, then if there is a 10-bagger, if there is one of those those surprise moves that we're all hope for, I'll be on it. But it's an added bonus because I've got a positive expectancy strategy that I'm expecting an on average return from the stocks that I'm looking at, and occasionally you hit the 10-bagger. VLO at the beginning of last year was one such. It was just a regular trade, and at the start of the trade in the energy sector, it was one of those stocks that was actually underperforming relative to the other energy stocks in the sector. And I was thinking, I'm going to have to kill this. It's a donkey. It's not great. And then out of nowhere, it just leaps and bounds, accelerated up and up and up and up. And to this day, it's one of the better trades just because of the situation, the circumstances, the way that I like to check in, check for trades, check out, and not look at things all through the day. Just by that process, that became it was a cat's whisker above 1100% return on capital using stock option as an alternative to trading stock. It quite literally exploded and produced one of the best results I've ever experienced as a percentage return. Monetary, I've had bigger monetary gains just because of, again, situation, but as a percentage return, it was certainly a headliner. But if I tried to aim for that every day and every opportunity and hope that it's going to be like that, again, it's a fool's errand. So anyway, I go off the beaten track. Getting in patience. Be patient. Be more of a farmer of opportunities rather than a hunter, because hunters can go hungry if they don't find something to kill. Whereas a farmer, if you nurture and grow a crop of opportunities, a crop of strategies, a crop of individual stocks, then you'll never go hungry. Number 5, ignoring the trend. The trend is your friend until the bend at the end. It's an old adage for a reason. It's also, as a result of that, a cliche. This is kind of important for any strategy. Now, most novice traders might look at the last few bars, and I mean really zoomed in at the last, 3, 4, 5, maybe 10 bars. And even if they've got a lot of data loaded on the charts, they've got tunnel vision for the right-hand side of the charts. And those 3, 4, 5, that's not the trend, and there's no way to see what the trend is. Sit back at the chart, lean back, take the whole view into account. And what I like to say is it depends on the time frame you're using. Look at at least 250 to 300 bars on the chart. If you're looking at daily charts, that's about 12 to 15 months on the chart as a minimum to assess the trend visually. And there's lots of mechanical ways to use it. One of the methods I teach is a combination of moving averages. But what we're able to do visually is confirm what we're expecting to see. It starts at the bottom left, it finishes at the top right. It is trending. Now notice the way I say that. You start to be able to make statements. If you explain the concept to a 6-year-old, hey, if it starts at the bottom left and finishes at the top right and it zigzags between the 2 points, then that's what we call a grade A trend. Okay. and you explain that concept, even without the visuals. I appreciate we're on a podcast here, but even without the visuals, you can visualize what that looks like. You explain that to a 6-year-old, and they will be able to go, yep. Oh, no, that doesn't meet that criteria. So we want to be able to look for trends because it's going to help us to buy the dip. You can't buy the dip without a trend. Neither can you sell the rally without knowing the trend. Now, depending on what you like, some people like to counter trend trade. Well, guess what? You still need to know the trend to be able to counter trend the trade. And if you like trading ranges or breakouts, well, guess what? You need to identify that it's not trending and we're in a consolidation. Now, these are all, like, I refer to these as my 6 money making patterns. We want to buy the dip, sell the rally, buy range lows, sell range highs, buy the break of range lows, and buy the break of range, sell the break of range lows, buy the break of range highs. So basically, you've got the 6 things checked off. The 2 trending, and when there's 4 patterns for ranging, and the 2 dark sheep of the family are the counter trend. I prefer not to do them. It doesn't set well with my personality. But nonetheless, there's 6 money-making patterns that I use. There's 2 bonus ones, again, if you choose to, but that's what I teach all my traders. But everything that we do revolves around trend first, and then opportunity second. And again, when you look at enough data on the chart, visually, it's possible to see what the trend is. And if it is an uptrend, you can go, great, I'm looking to buy the dip. And you can't buy any dip without knowing what the trend is first. And we need to see an uptrend to buy the dip, a downtrend to sell the rallies, etc. See where we're going with this. And this seems really common sense stuff. And it comes back to when you've got a plan, I can define what I do and look for as a trend. Then I can also define what I look for precisely as not just a dip, any down day, any down move. I'm looking for what I consider to be a buyable dip in the context of a trend. And just adding that qualifier, the trend, I can start to apply rules that become a checklist, and certain conditions, mechanical rules, have to be met before I'll say, yeah, not only is that a dip, but that's a dip worth buying. Great, that's what we're looking for, that's what we're waiting for. And it comes back to this: patience is needed, and a plan is needed, so that you know what you're looking for, when you're looking for it. You can just wait for those opportunities and farm the profits out the markets. Oof, nearly there. One more, folks, bear with me. Now, lastly, unrealistic expectations. We kind of touched on this at the top of the show, but this one doesn't necessarily apply to everyone, but it happens often enough to make note of it. Now, most seasoned and battle-scarred traders just simply want a strategy that they know works to follow. However, there are some small few that want to be or need to be correct 100% of the time. And every trade idea should go to the moon or be a 10-bagger. Again, go to Reddit forum, Wall Street Bets. You'll see what those people are bragging about. Because they don't have a plan, they don't have the patience, they don't have the realistic expectations, because they're not thinking about trading like a business. So, coming back to that real world of I'm exasperated. Oh, it depresses me thinking about this type of person. Again, it's probably no one listening. So if you're listening, and this is you, have a little bit of a reality check. Again, most people are not like this, but nonetheless, some small few are. So hopefully this is a reality check if you do find yourself doing this lack of reality. Anyway, coming back to the world of business, it would be unrealistic to expect every customer to come in and buy one of every product, one of every size, and one of every colour. Now, it is possible. Mr. Beast, if you ever heard of him, he does periodically go into random shops and quite literally buy everything on the shelves because it makes good TV. Doesn't want it, but it makes good TV. But because it's happened once, people can think it can happen to them. Now, trading is a business, and while the occasional trade can go to the moon, as I've illustrated, it's certainly the exception to the rule, and it is critical not to expect every trade to be a winner or go to the moon. All you're looking for is a result, a profit on average, based on a positive expectancy strategy, just like the real world of business. I want an on-average return at the end of the day, the week, the month, maybe even the quarter, or possibly the year. You're assessing over months, quarters, and years if you're profitable. Not at the end of every 5 minutes or maybe even the end of the day. You're looking for the on-average return, and that is critical to everything. Now, you're going to make mistakes. We all have them. I've certainly had my fair share of crying in the corner moments, and I'll probably have more in the future. we're human. We're going to make mistakes. I'm going to press the wrong button. I've done it plenty of times. But as you get more experience, the time between those errors, the time between those mistakes gets further and further apart. And again, just acknowledge that, when you're brand new, you will press the wrong button from time to time. And the mistakes that you make will be more frequent perhaps, but as you gain experience and you learn from them, you realize that if you make the patience and you don't hastily click confirm and send, and you go through that production line process that you've got for your training, that I teach all my traders, then the errors and mistakes will get further and further apart, and that's fine. So the occasional mistake's okay. Beginner mistakes are okay. Start trading on a demo account so that you can make all those I pressed the wrong button mistakes. You can get them out the way first on a demo account without risking any money, because you're going to have to learn the charts, the technology, the brokerage. Then you've got to learn a strategy and make sure that you understand it and you comprehend it. You can make all those learning mistakes in a safe environment. Just imagine for a moment if you could start a real bricks and mortar business, someone who's got 30 years in the trenches of running teams, hiring, firing, stocking the shelves, staffing the shelves, and for 3 months, 6 months, they work with you to start this profitable business. They've got a blueprint for success, and they work with you and they show you what to do, how to operate, which levers to pull behind the scenes, how they do and operate a successful business. And then when that business is profitable, they hand you the keys and they go, there you go. Here's a profitable business. All you've got to do is pick it up and carry it and do the things that you're already doing, because you've learned how to run a business in a safe environment at no risk. So stay on the demo account for as long as you need. Anyway, recognize that you're going to make mistakes. Let them develop your experience again and make that mistake a lesson. Again, do it in a safe environment, but at least you're going to be aware of the mistakes before they happen in an unsafe environment where, if you make a mistake on a real money account, you're going to be like seeing a rabbit in the headlights on a dark night. You're going to be startled. You might not know what to do. But if you can kind of figure out what to do on the demo accounts, then that makes sense. So learn from the mistakes. Learn from them before they become an issue or a problem for you. And the sum of your experience is the only thing that no mentor can give you. So you've got to kind of walk through the hot coals from time to time. But again, as I keep trying to illustrate, you can do that in a safe environment on a demo account. But at least now you're aware of 6 of the more common trading mistakes and errors and pitfalls that you can experience. You can now walk forward with your eyes open and your brain's open as well, and be aware of these before they ever become a problem, because so many traders go through their trading career and blow up account after account and wonder what's going wrong. And these are the most common areas that are contributing to them and their failures. But now you can use these as a springboard for your successes. Keep in mind that futures, options on futures, stocks and stock option trading involves a degree of risk that may not be suitable for all investors. Past performance is no guarantee of future performance. Antivestor provides educational information and does not provide financial advice.